Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back to Strongman Personal Finance. I'm Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3. Rip off! And current evaluator of Sony stock. Now here is this delicious stock analyzer tool that I totally did not invent, but I actually used somebody else's. I looked at it and I said, I can potentially create this for myself, but I can make it more flexible than what the software gives me. I'm using Everything Money's format, okay? I didn't hack them and steal this. I made this myself. But yes, this may look familiar to you, but I've added some garnishes. Meet Kevin, this idiot, George Lopez Perez, Dogecoin Duchesnaire, Stinkmo, Stinkblow, and Jeremy Lefebvre. So, we're going to look at Sony stock today. Sony is a big old Japanese company. Everybody knows about Sony. Don't they make the PlayStation? I'm actually an Xbox guy, but whatever. So in this tool, what I did was I was so intelligent that I was able to access Morningstar, and you can get Morningstar potentially for free at your local library. You have to ask. I get Morningstar for free at my library. I go to I search the stock, Sony. I go to key ratios right here. I get full key ratios data. That pulls up this screen. I hit export. It should have an Excel sheet come out. And then I take the Excel sheet, which is this right here. I copy it from B4 over to L4. And then I copy it all the way down to B111 to L111. And then I paste it into my analyzer key ratios tool right here. So we're going to paste it right here in the B4 spot. Well, I already pasted it, but whatever. And it automatically populates. Now, you want to highlight it like I showed you if I actually ever release this, because there's actually calculation data down here. I mean, maybe I can move this to a different tab. But as of right now, you have to copy it exactly, because if you copy the entire freaking slide or the entire freaking data sheet and paste it into here, it's going to override all these formulas. So anyway, all the assumptions, all the data is in here. And it does the same freaking thing as Everything Money's does. So with Sony, I said for revenue growth, low of 2, high of 4. Why do I say that? Well, using the Morningstar data, revenue growth year over year. It's freaking all over the place, okay? -9, 4, 14, 5, -1, -6, 12, 1, -4. It's freaking all over the place. But if you really think about it, Sony's a pretty big freaking company, okay? So it's probably going to grow roughly at the rate of, GDP growth, or maybe a little bit with inflation on top of that. It's not going to be a super fast growing company, especially if you're looking 5 years in the future. So because I'm a conservative individual stock investor, I prefer index funds unless I can find an amazing deal with conservative assumptions and a 15% return. I'm going to be really careful. So I use 2, 3, and 4%. Now, you can use different numbers. You can use Everything Money software or whatever. You can put 4, 5, 6, 7, 8, 9, whatever you freaking want. But I'm very conservative. Share change. You go back, look at the key ratios. Look at the shares. Over time, looks like they issued a bunch in 2015, a little bit in 2016 and 17, and then they've bought back a little bit. So I said, worst case, they don't buy back any. Best case, they buy back 1%. They may even issue more shares. I don't know. So really up to you. It's really up to your thought process, because they've historically done it before. Profit margin, 7, 10, 13%. If you go to the profit margin, net margin, it's all over the place. But you can kind of get a feel for the range here by looking at 2019, 2020, 2021. I'm thinking, 7 to 13%. There are lower numbers here, and if you want to be super conservative, you can even do like 5%. 7.5 or 10. It's whatever you want to do. It's your analysis, okay? Free cash flow as a percentage of revenue, 9, 10, and 11%. Go back to the key ratios. It's highlighted, and we have it here. So here's been roughly the range since 2018. 9, 10, 11, something like that. And then about 9.7 over the last 12 months. So I think that's pretty reasonable. 9, 10, 11. Now, price to earnings ratio. Like I said, Sony's a mature company. They have low revenue growth, or I project they will going into the future. Very conservative. Because of that, their PE ratio should not be high, okay? You're not going to pay a lot of money for low growth. And Sony's PE right now is like 12, okay? So think about 5 years in the future. I think 8, 10, and 12 for PE and price to free cash flow is pretty freaking reasonable, okay? And then, of course, desired annual return, 15%. Now, here's where you got to be careful with these freaking tools that you use. You need to factor in the exchange rate, because if you look, so I didn't copy over this column A because it says USD millions, but if you go to Morningstar, these numbers are actually in Japanese yen. So you need to go and find the conversion rate, Japanese yen to USD, and then you need to factor that into your stock analysis. So I actually converted it here. I placed the conversion rate here, and that actually spits out the correct dollar number. Because if you look at this, it's like, oh, this should be an $11,000 stock, and it's only 108. Oh my God. Wrong. This is in yen, okay? Yeah, it says dollars, but I'm not going to freaking change it every time, and I mostly look at US companies. But yes, this is the actual correct numbers because you have to account for currency. So as you can see right here, I mean, the stock's trading for 108, and if you want a 15% return, I mean, none of the numbers hit that. It's all red. I mean, if you wanted to get a 10% return, okay, it's potentially a buy if you believe these high assumptions. 4% revenue growth, 1% share buyback, 13% profit margin, 12 PE. I mean, that's reasonable. That's not crazy. But you're not going to get this banger return with freaking Sony, okay? I mean, it all depends on what you want. But for me, if I'm going to buy an individual stock, I want to be rewarded handsomely for taking the additional risk of not buying the index or buying every company in the world. So I'm not buying Sony. I do like some stocks. We're going to look at JD next. I think JD's okay right now. It was a sweet, screaming deal just a couple of months ago. Now it's okay. But Sony is not something I'd be touching. It's also just kind of freaking all over the place. So if you have a hard time projecting stock, you know, or a lot of the numbers are just hard to really value because they're freaking all over the place, you don't have to consider the stock, okay? You don't have to. So that's it. I am not buying Sony. I think it's a little risky right now. I think it's a little expensive. I mean, I think it was cheaper earlier in the year maybe, but right now, no. I want a 15% return. That's it. Like, subscribe, tell your friends about me. Tell me your thoughts about this sexy tool I made with these additions. Is this distracting or do you enjoy seeing these clowns on here? That's it. Choose.